I just sent a link in the chat box. If you can, everyone, please fill out the 30-second survey. It is related to the presentation I'll have today, and then I will talk about that close to the end of the paper. I assume you can all see my screen and hear me. So thank you so much for having me. I'm going to present. I'm going to present this paper called What Drives the Size and Value Factors. This is the motivation of the talk. We know that size and value factors play very prominent roles in finance, both in academia and in industry. Now, in academia, obviously, we have the Fama-French three-factor model, which augments CAPM with size and value factors. And it is one of the most widely used in asset pricing to explain the cross-section of expected returns. In industry, people have been trading these factors for a long time. It used to be quantitative hedge funds, but in the recent decade, they are also accessible to retail investors via these smart beta ETMs. As of 2018, value in the US is the most popular smart beta ETM strategy by AUM. Even though these factors play these prominent roles in finance, we still don't understand what drives them. For example, if you just look at the value factor by itself, in the 2 years of 1998 to 1999, it dropped almost 50%, like a half of it. And in the subsequent 2 years, it went up by more than half. What drives all these large factor level movements? Since 1995, by a paper by Fama-French, we knew that these factors moved too much to be justified by changes in earnings. It would be very comfortable if all these movements, for example, if value factor went down because value firms didn't do well in terms of cash flow, but that's not the case. Most of the factor movements are not justified by changes in earnings. In other words, these factors have an excess volatility puzzle that we need to explain, but we still don't have an explanation. To explain the movements of these factors, there are two views that we want to differentiate. One is the efficient market view. This is the view that factor movements reflect time-varying risk premium, or the so-called discount rate variation. I'm quoting a few papers, but the list goes on this view. For some researchers, they would argue that even the existence of a factor structure immediately suggests this rational explanation. For example, John Cochrane in his AFA presidential address says, these behavioral ideas do not easily generate this kind of coordinated movement, this factor level movement, across all assets that just look like a rise in risk premium. This forms the efficient market view. There's also a mispricing view, which is that factor movements don't have to be fundamental. They could be non-fundamental price pressures that are driven by large demand shocks. This view started in 1994 when people debated what drove the value factors, and is well articulated by the style investing paper in Barberich and Schleifer in 2003. So these are the two contrasting views people have been debating on for decades. This is a summary of my paper. It's divided into two parts. First, I will document that over 1980 to 2018, over 40% of the movements in size and value factors are non-fundamental price pressures. The mechanism is very straightforward. Mutual fund investors periodically reallocate across funds with different style. For example, in a given year, they could be selling value funds and putting their money more into growth funds. When they do so, they induce the mutual fund managers to trade accordingly. In my earlier example, that causes buying pressure in growth stocks and selling pressure in value stocks. That is going to create factor level demand. This demand is very large, and it generates price pressures that revert over time. The second part of my paper will present evidence for the price pressure mechanism. So you might wonder whether these price pressures and reversions are truly price pressures, or maybe they can be explained by something else. I'm going to argue that it's very difficult to explain them with something else using this evidence, which is that these flow or demand-induced price movements happen exclusively intraday and not overnight. If you divide returns in a day into intraday, which is the open price to close price, and overnight, which is close to open, I will document, and is also consistent with prior literature, that mutual fund trading primarily impact the intraday component, because that's when mutual funds actually trade. Consistent with the price pressure coming from mutual funds, all the price pressures I'm talking about in this paper happen exclusively intraday, but not overnight. This is consistent with price pressure, and it's very difficult to explain using other stories.
Jay, we've got a question.
Yeah.
It's from Haibei Zhao, and it's a two-part question. The first part is, how do you reconcile your finding with Wardlaw's forthcoming JF, where he shows virtually no price impact due to mutual fund flows, even in the most extreme cases of outflows?
Yeah.
And then the second part of the question is, if state variables are stationary from day to night, why do we have the tug of war result in Liu, Polk, and Skuras?
So first of all, the Wardlaw question. So Wardlaw shows that there's some constructions of flows that are problematic. I'm not going to go into detail, but my construction of flows, which follows Donglu's RFS 2012 paper, does not have that issue. I actually had this discussion with Wardlaw himself. The second question about the state variable about day and night results, I might have to defer to when I touch upon this part.
Thank you.
I guess it's hard for people to ask follow-on questions immediately, but okay. Overall, my findings are supportive of this mispricing view, that lots of factor movements are non-fundamental price pressures and not driven by fundamental reasons. This paper is related to the literature on the impact of non-fundamental demand on prices. We all know that these literature started with index inclusion, and later it went to fund flows. This is where my paper falls into. My paper is also related to understanding the dichotomy between intraday and overnight returns. The results I'm presenting is a further evidence for the tug-of-war clientele interpretation, that some people trade more intraday and some people trade more overnight. This is the outline of my talk. I'll first show that these factor level demand pressures drive price movements and cause price pressures, and then go into the day and night evidence of the mechanism. You might ask, first of all, why do I look at size and value to begin with? Well, the reason is I'm looking at flows from mutual funds, and because of that, it is natural to look at size and value. Mutual funds have long been classified into size and value categories. For example, we're familiar with the Morningstar style box. It classifies funds, equity funds, into these 3x3 dimensions, exactly following the size and value definitions. Also, funds make themselves very easy and convenient for investors to reallocate money at a style level. In fact, a high fraction of funds even directly put styles in their names. For example, you could have the Fidelity Growth Company Fund, making it very clear that they're investing in growth stocks. On an asset under management weighted basis, this is the fraction of funds that clearly have style related names. So what I've done is simply did a search of these kind of names like value or growth in these fund names, and this is what I found. On a value weighted basis, as of today, more than 40% of funds have style related names. Further, mutual fund investors reallocate massively across styles. What I'm plotting here is the annual fund flow by style. So this is dividing mutual funds into the 3x3 Morningstar categories of styles. And what I'm plotting is the annual fund flow by each style. As you can see, the style level fund flows are large, easily amounting to 20% or negative 20% of the fund AUM. For example, if you just look at this period I alluded to earlier, before the dot-com bust, growth funds got a lot of money. So this is mid-growth they got in that given year, it received more than 20% inflow. After the dot-com bust, everything reversed. Flows went out of growth funds and into value funds for a number of years. These flows are very large. It is also natural to hypothesize that these flows might cause non-fundamental price pressures because these flows are driven by mutual fund investors who are predominantly retail. And existing literature found that they often exhibit not so sophisticated behavior when they reallocate across mutual funds. For example, Frazzini in 2008 showed that just by reallocating money across funds, mutual fund investors destroy some of their own wealth. Some other recent papers also found that they are ignorant about factors when they do so. Therefore, it is natural to think of this as generating non-fundamental demand pressures.
Jay, we have a question.
Yeah. Yes.
It's from Vikas Agarwal, and he says, you need two assumptions for the whole setup to work.
Yeah.
First, mutual fund investors need to put money into funds in a way that contributes to the changes in the size and value factor premium. That is, when effector returns are higher, we should see more money going into small cap and value funds. And he said the second thing is we need funds to invest more in these stocks after they receive flows. Second assumption is more likely to hold, but not sure how you can generate volatility in factor returns given that fund investors chase past returns.
So the first question is, yes, that's exactly what I'm going to document. So the flows, factor level flows by mutual fund investors are contemporaneously correlated with factor movements, and that component of factor movement revert over time. The second question is, yes, so it has been documented by prior literature, again, in the Donglu RFS 2012, and also to some extent Koval Stafford, that when mutual funds receive these inflows and outflows, they trade accordingly. So approximately what happens is, I'm a mutual fund, I get inflows, I put more money into all my holdings proportionally in response to this. If I get outflows, I sell proportionally. That's roughly what happens.
And we have another question from Yuhua Tong.
Yeah.
He says, funds trade extensively in the closing auctions, especially in recent years. This could materially impact the closing prices. How will this affect your open to close and close to open decomposition of daily returns and your conclusion from this analysis?
Yeah, this goes in the direction of my test. So my test is, I'm going to present evidence that mutual fund trading primarily impacts the open to close returns, and the close return includes, the closing price includes the closing auctions impact. So it will help me.
Okay, thank you.
Cool. Okay, so this is my data. The data is going to be quarterly sample starting from 1980. The start date is just based on data availability because I need to have holdings data, which started in 1980. Over this period of time, mutual funds held an average of 13% of the overall equity market. So they're a sizable fraction of the market. Of course, they started a little smaller earlier, and nowadays they're like 30% of the market. My data sources are entirely standard, nothing interesting. Mutual fund flows come from CRISP, holdings are from Thomson Reuters, the stocks are from CRISP and CompuStat, nothing fancy here. These are the two variables I'm using, and I'm going to use this second variable following a low 2012. Fund flows at the fund level is defined in a standard way, which is the change in fund AUM that is not explained by fund returns. So if a fund suddenly have a big increase in AUM that's not explained by its returns, that is an inflow. Otherwise, it is an outflow. Flows are defined as a fraction of lagged AUM, just as a normalization. Because I need to talk about stock level price pressures, this is going to be converted into this measure called flow-induced trading, or sometimes also called FIT for short. It is at a stock level. This is defined as what would have happened in the trading of the stock if fund managers proportionally expand or contract their holdings based on flows. And again, normalized by the overall amount of shares held. This measure came from this paper. It is supposed to measure the non-discretionary aspect of mutual fund trading. Now, mutual fund managers are intelligent people, and they can be trading stocks for very fundamental reasons. So we can't look at all their trading. This is also the problem with what Wardlaw pointed out in some of the previous papers, which I'm not going to go into detail on that. You need to look at the non-discretionary part of their trading that's only in response to flows. And this is what that measure captures. If the manager has trades more or less in response to flows, this is not going to capture that. This is only capturing the amount of trading that is just induced by flows itself. I'm going to then measure these flow-induced trading at the stock level and aggregate them up to the factor level. Now, I want to emphasize that this specification is pioneered by a paper by Shiyang Huang and Yang Song and I'm forgetting the third author's name. So they did this first. So what we are doing here is that we're constructing flows into size and value factors by aggregating the stock level flow-induced trading up. So this is the way Fang and French define their factors. You sort stocks by market capitalization and book to market into these 6 portfolios. So instead of using returns, all we are doing is we are looking at the flow-induced trading in every stock and then aggregating them up into these size and value factors. This is going to be my measure of the mutual fund induced flows into and out of these factors. Now, I think this is related to one of the earlier questions, which is, if flows are idiosyncratic, they don't flow in any particular direction, then we will not expect large demand imbalances at the factor level. Of course, what I showed earlier about the big style level flows in funds also suggests actually, yes, you will actually see large demand imbalances at a factor level. People are not reallocating randomly. People are reallocating it very much at a style level. The first thing I want to tell you is that the factor level flows are large. What I'm plotting here is, this is for the size factor. These bars are the flow-induced trading in the size factor at an annual basis, and these lines the factor returns, the Palmer French factor returns. The flow-induced tradings are quite large. In a given year, it is very easy for you to see up to 15 or 20% of net inflow into the size factor driven by mutual fund flows. Some years positive, some years negative. You will also see that these 2 series are correlated contemporaneously. That doesn't mean it necessarily is price pressure, but it's indicative of price pressures. I'll go into more detail later. This is the size factor. This is the value factor. Roughly similar results. In a given year, you can easily see 10% outflows. These are very, very large flows. To put things into dollar terms, if you look at the dot-com boom period, for instance, flows drove an additional demand of $185 billion in growth stocks relative to value stocks. In that period, the flow-driven demand of growth stock is this much higher than value stocks. Similarly, in that period, people also favored large cap. So there's an $184 billion additional flow into large cap stocks relative to small cap stocks. And to put numbers into perspective, this was more than 3% of the overall market size in that period. So we are talking about fairly large flows here at a factor level.
Jay, we've got a question.
Yeah.
It's from Sugata Ray, who says, I feel that this could explain some of the recent papers showing momentum exists across the factors. Is there some way you could link these flows to show that they drive momentum across the factors?
I'm not sufficiently familiar with that paper to comment. I think I know which paper you're talking about. I do have another paper with some co-authors showing that mutual fund flows partially account for momentum profits. And in fact, we show using an identification method, which Morningstar changed its rating methodology in 2002, and that disrupted how flows contribute to momentum, and then momentum immediately lost profitability. So yes, flows do contribute to momentum as well. And to be fair, Lu 2012 also pointed to how flows contribute to momentum. But for that specific paper, I don't know enough to comment.
Okay.
I should look it up. Thank you. So factor level flow induced trading is large. As we said, you also say that, look, they are highly correlated. And let's look more into that. That doesn't mean it's price pressure. Whether it's price pressure, the key test is, do they revert? Do the flow-driven factor movements revert? So what I'm going to do is I'll estimate a panel regression on factor returns. I'm putting both factors together right now. So I'm regressing factor returns on contemporaneous and up to 12 lags of flows into these factors, controlling for lag returns. What I'm plotting down here is the cumulative response of return to flows. So the first coefficient is B0. This is a contemporaneous term. And then the second one is B0 plus B1, which is a cumulative response to 2-period flow, 3-period flow, etc. This traces out what is effectively an impulse response. So what you see is for every 1% inflow into a factor, what happens is that factor return moves by roughly 2% contemporaneously in that quarter, and that flow-induced factor movement fully revert in 1 or 2 years. I think for me, this is really the key evidence about whether this is non-fundamental price pressures. If this is fundamental driven, or driven by some kind of fundamentals, we wouldn't expect such strong reversion afterwards. The explanatory power is very large. So this is the front line result I alluded to. If you just look at this regression, the marginal R squared of flows explaining factor returns is 34% at the quarterly frequency. At annual frequency, this goes up even further because the flows in mutual funds are actually quite persistent. If in a given quarter flows are going into value, it will keep going to value next quarter. A little lower, but still going to value, keep pushing the same direction. Therefore, if you look at this at an annual frequency, this explanatory power goes up to almost half. And this is the front page result I quoted earlier, that flows can drive 40% or more of factor movements.
Jay, we have a question from Vikas Agarwal, who asks, why does it take 1 to 2 years for the factor returns to reverse? Given that there are several ETFs based on size and value factors, why don't investors take advantage of price dislocations due to fund flows?
So I'll try not to give a very long-winded answer to this. But there are two things. One is it's unclear whether all investors are aware of these factor level flows and find it easy to measure. If this is all very easy and obvious, then maybe I shouldn't be writing this paper to begin with. The second answer is the best way for investors to take advantage of this, especially shorter term investors, is not to trade against these flows, but to ride on them. So I'm in talks with a fund flow data company that sell these fund flow data for a fee for the past 2 decades. And what they've been telling me so far is that their clients, especially sophisticated clients, the way they use it is to ride these flows, not trade against it. Because as I said, flows are serially correlated, so you can predict flows to some extent. So if you know money is going to growth funds, pushing growth stock even further tomorrow, the best thing to do is to put more money into growth today to ride on it. Whereas the reversion is slow, it's sort of self-perpetuating. Because the reversion is slow, these people don't trade on the reversion, it's just too long for them. They primarily ride on it. In other words, this is very similar to what Nagel showed for the dot-com bubble. In many cases, arbitrageurs find it easier to ride on these price dislocations and exacerbate them. That's the best way to make money and not necessarily trade on reversion. Now, obviously, this is an anecdotal example, and I'm trying to get data from that company to show that.
Okay, we have another question from Paul I, and he asks, how does this paper differ from flow-induced trades and asset pricing factors by Huang, Song, and Xiang?
Yeah, so the main difference with that paper is the focus. So this paper primarily focuses on showing that flows explain the second moment of returns or the variance of factor returns. That's why we also go into more detail trying to look at exact mechanism, day and night separation, etc. From what I understand, the other paper is primarily focused on trying to argue that flows actually explain the expected returns of those factors. So the story in that paper is that flows lead to these noise movements in factors, and they show evidence that arbitrageurs are aware of this, and therefore these are priced in a cross-section of factor returns. So the short answer is I'm focusing on explaining the variance of returns, and they're focused on explaining the average expected return.
Okay, thank you.
Okay, so flow-driven factor movements do revert. You can estimate, so earlier I estimated this together with size and value factors. Together, you can do this separately using each individual factor. You have less data doing so. Roughly similar patterns show up. You have wider standard errors, but roughly similar patterns. Price pressure and reversion afterwards. This is me trying to visualize explanatory power. So what I'm plotting is simply the amount of return movements that are spanned by flows. And the coefficients are just estimated in the regression I showed earlier. The black lines are the actual factor returns and an annual frequency. And the red lines are that explained by flows. So flows explain the sizable fraction of the overall factor movements. That's where the 47% number comes from. It doesn't explain everything. So for example, if you look at .com, there was massive money going into growth in the .com boom, and a lot of money going into value out of growth after the .com boom. It doesn't explain the whole thing. There are other things going on for sure, but it explains a sizable fraction of the overall factor movements. This is a question that people familiar with the literature might ask, so I'm putting in here. So is this really different from what we learned about the stock level results from like Cobo-Stafford, for instance? And Cobo-Stafford shows that mutual fund flows cause price pressures at the individual stock levels. Now, if you take that as a given, now the factors are, after all, just portfolios of stocks, then maybe this is just repackaging old results from Cobo-Stafford. I'm going to show that's not the case. What I'm documenting is really like broad-based factor level price pressures. And to address this, I will follow Farmer French 1995 to do this split sample exercise. What I will do is that I will randomly split stocks into two disjoint samples. Here, let's call them sample A and B. These are different stocks now. And now I'm going to construct the flow into every factor using one sample, such as sample B. And I'm going to construct factor returns using sample A. So now these are disjoint samples. If the price pressures are only at the stock level, then we should expect no effect when I try to use the flows from sample B to explain the returns of sample A, if everything is only at a stock level. I'm going to do this 1,000 times to make sure this is not due to randomness. I redid this exercise, plotted the impulse response functions, and this is what I got from the split sample exercise. It's actually quite different from the full sample results. You see the exact same price pressure and reversion patterns. Therefore, what this suggests is that these are really factor level broad market price pressures, and they're not simply repackaging the stock level price pressures documented earlier. That's the first part of the paper. Now let me go into the second part about looking at the day and night evidence of price pressures. Now, my argument for price pressures so far is similar to other papers on this topic. So I argue, look, mutual fund investors are predominantly retail, often not sophisticated. The flows are large. It generates price pressures in the reverse over time. So therefore, please believe me. So if you're sympathetic to the mispricing view, this might be sufficient evidence for you. But to be very fair, I have not at all ruled out alternative hypotheses. How do we know it is not possible to explain our findings using some simple rational stories that don't have price pressures? That's what I'll go into right now. This is a graphical illustration of a large set of alternative hypotheses. Is that the flows and prices are both driven by other state variables. This is a story I'm telling in the price pressure story, which is flows directly cause, each arrow here is a causal link, flows directly cause price movements, and those price movements revert. The alternative hypothesis, this is really a general class of alternative hypotheses, is that flows don't directly cause prices. There's no link here, but both flows and prices are driven by some other common state variables, which can possibly be unobservable. And my main evidence is flow-induced price pressure reverse, so that's a dynamic relationship. But if you just allow for more flexible relationship of flows and returns on these state variables in a dynamic way, then in principle, everything I document can be explained.
Jay, we've got another question. It's from
Yeah.
Christian Chu, who asks, he says, what about Lettow, Ludvigsen, and Manuel's observation in 2018 that funds do not tilt enough towards value or size, but rather away? This would be explained by Dow, Kogan, and Wu 2020, who argue that mutual funds actually hedge flows so as to not lose fees.
Yeah, so I think that paper, if I remember correctly, that paper is documenting that what so-called value funds in the industry are not sufficiently value oriented in the academic sense if we define using book to market. That is true. However, if you look at just a cross section of funds, they still differ significantly on the book to market spectrum for them to. Therefore, if differential flows hit them, then they're still going to create substantial differential flows at the value factor level. That's also what I showed earlier. If all of these funds, the key of what I need is the funds holdings need to differ sufficiently on the book to market spectrum. The value funds may not be sufficiently valued, that's fine. What matters is whether these funds sufficiently differ on the value versus growth spectrum. And the answer is yes, they do. So for my purposes, that would be fine.
Okay, thank you. Actually, there's a follow-up here because Christian says, because those who respond more and hedge flows less are enough to move prices.
Those who respond more to hedge.
Right, so, right. So I thought that what you said is, I mean, exactly that. So there is enough cross-sectional difference. So those who basically behave less like in Lettow's paper are enough actually to generate your effect.
You mean to offset the effect?
Yeah.
Okay, so in the earlier version of the paper, there's a section I took out, but I looked at exactly how these funds trade. Not to go into too much detail, there's a little bit of going against flows going on, but on net, it is not anywhere close to going to offsetting it. So primarily what I found that thing, which is not in the current paper, is that active funds, relatively active funds, do trade a little bit against flows. It's just that they tend to be too small. Passive funds don't trade against flows. And as a consequence, they offset a little bit of the overall flow-induced factor movements, but not much. There is a little offsetting going on. That is true.
Thank you.
Thank you. It's hard to interact this way. Thank you for speaking out. So this is the alternative hypotheses, right? Some state variables drive flows and prices in some way. Now, there are many possible candidate state variables. Many of them are unobserved. I'll give you a list in 2 slides. But because many of them can be unobservable, that at first glance, this alternative seems impossible to refute. However, I argue that there is an additional prediction that is very specific to price pressures that I can test, which is they should happen primarily during the day. So typically when we think about daily returns, we are talking about close to close returns. Yesterday's closing price to today's closing price. So what previous people have found, like for example in this Lowe's paper, is that if you divide up returns into day and night, they look completely different, behave completely differently. Day return is defined as the price from movement from today's open to today's close, and night is from yesterday's close to today's open. So what they found is, first of all, these 2 components returns tend to go against each other, and they found evidence that seems to be related to clienteles. That institutions trade more during the day and retail investors trade more during the night. Therefore, retail investor trading is primarily correlated with the overnight returns, and institutions are primarily correlated with the intraday returns. To be clear, what they're not saying that retail investors trade literally during the night. What they meant is retail investors they work during the day, they go back home, market's already closed. They submit orders to their brokers, and the brokers will execute them at tomorrow's open. That's why retail trading tends to impact overnight returns. I'm going to soon show evidence that this prediction is particularly true for mutual funds. Mutual fund trades primarily impact the day component, not the night component. It is also consistent with the maybe even not, I say anecdotal, maybe even not even anecdotal, the evidence that mutual funds primarily trade during the day, and in these years, increasingly towards the close. Therefore, we should, if what I'm documenting is really price pressures from mutual funds, we should expect most of the price pressures to happen during the day, not overnight. So that's the new test I'll go into.
Jay, we've got another question. It's from Vikas Agarwal. He says, a lot of flows into mutual funds are through the retirement accounts. That is unlikely to vary with factor returns. It may be interesting to show that trading induced by retirement flows do not show this pattern and these effects.
Yeah, so I actually don't know how to separate flows into those driven by retail by retirement accounts and not. If there's a way, I hope to maybe discuss offline to know how to test that.
Yeah, absolutely. And so, by the way, we'll keep this open for a bit after the formal presentation, so that if you have any other, so you can interact with anybody who has a question like that and can follow up.
Sure, great. Yeah.
Yeah,
so that's also my by the way, that's also my intuition, and there's findings on this as well, which is most of these are driven by sort of some mutual fund investors who actively reallocate and change returns or just change their views on styles. Retirement accounts will probably be much more passive. Going back to this paper, this day and night test, I argue, is a pretty sharp test because the alternative hypotheses are not going to generate it. It is true that we can come up with many possible state variables that drive time-varying risk premium. And the existing asset pricing literature give you a long list. For example, the state variable can reflect time-varying preferences, like in a habit model, some type of time-varying cash flow risk, like a long-run risk, time-varying disaster probabilities, or time-varying perception of disaster probabilities, or time-varying intermediary wealth. They can all generate price movements, and they are all possible state variables. The issue with these state variables is that they tend to be slow-moving. Like habit formation, that state variable doesn't change day and night. Like intermediary wealth does not change day and night. They do not vary at that kind of high frequency. At the minimum, these alternative hypotheses, whatever they are, do not make differential predictions on day versus night returns, but the price pressure story does. In the empirical exercise, I'm going to follow this earlier paper to decompose daily returns into day and night components. This is just a definition I said earlier verbally. Day return is close to open to close, and night return is the component of daily return that's not in the intraday return. The data sources, after 1993, TAQ is available. I follow this existing paper to use volume weighted average price during the 30 minutes after market open as open price, 30 minutes before market close as the market closing price. Before 1993, there's no TAQ. I'm going to use Bloomberg open close prices to supplement that. Do mutual funds exert more impact on day returns? The existing literature suggests yes, but they have only looked at institutions as a whole and not mutual funds in particular. So I need to look at mutual funds in particular. What I've done is I'm regressing day and night returns on mutual fund trading, controlling for a host of other variables. Now, mutual fund trading is inferred from Thomson Reuters 13F filing. Therefore, it is at a quarterly frequency. It is defined as aggregate trading by mutual funds divided by shares outstanding. Because this is quarterly, I'm going to aggregate these intraday returns into quarterly frequency as well, but separate the day component and night component. Therefore, in every quarter, I'll have a day return component for this quarter and a night return component for this quarter. I'm also controlling for trading by other institutions, other 13F institutions, quarter stock fixed effects, and all the lagged day and night returns because of the documented reversal patterns. What I see is that mutual fund trades primarily impact the day return and not the night return. These coefficients are very, very different. This is a regression using the full sample starting from 1980. We can also look at individual subsamples. So what I've done is also to separate these time period into 5 subsamples and do the same thing. And the regression the coefficients do vary over time. The price pressure coefficient seems to change over time, but the results are always the same, which is the impact is primarily during the day. Night return impact throughout every one of these 5 subsamples are indistinguishable from 0, except one of them is slightly negative. Everything else is indistinguishable from zero. Therefore, my conclusion is, yes, mutual funds do appear to exert more impact on day returns and not night returns. This day and night decomposition also make it hard to tell the reverse causality story, because a natural thing you might think is, maybe this is not price pressures, maybe this is just mutual funds chasing returns. They buy stocks return that go up, they sell stocks with returns that go down. That's certainly true to some extent, but the problem is there's no reason why mutual funds would differentially chase day and night returns. If they chase returns, they chase the entire return. So this differential effect on day and night returns is likely coming from price pressures.
Jay, we've got a question from Yuhua, and he asks, can you further decompose open to close return into different trading hours? I'm interested to see the evidence in the period around closing.
Okay, I've actually done that. I'm not putting here on a paper, but let me tell you what I found. So I've decomposed intraday return into 30-minute components. So first of all, it's still true that overnight return, there's no impact by mutual fund trading. It's impact during the day. There is impact in every single period, but is stronger towards the close. This is also consistent with I think what you mentioned is that recently, especially recently, mutual funds trade more towards the close, and especially in the closing auction.
We have a couple others. Vikas has a suggestion. He says this analysis may benefit from high frequency Able Noser data, where you can see the daily trades of funds. So that's just a suggestion. And then we have a question from Rong Guo, who says, why do mutual funds have a positive effect on day return, but a negative effect on night returns?
So mutual fund trades don't necessarily have a negative effect on night returns. I think in all the subsamples except the last subsample, it was basically zero. So my conjecture, this is unfortunately only a conjecture, which is this is just some unobserved correlation negative correlation between mutual fund trading and retail trading, which I'm not capturing. That's my guess. The earlier Able Noser paper, thank you very much for mentioning. I've actually tried that too, which didn't have time to work into the paper. The same conclusion comes out if I use a daily trading in Able Noser. Yeah, the coefficient will be a little smaller. Able Noser doesn't capture all institutions. Yeah, let me not go into more, but yes, it works out in that data as well.
Thank you.
Okay, so now we're ready to look at whether price pressures happen intraday or overnight. What I've done here is I'm decomposing factor returns into day and night components. They behave completely differently. So these lines are the day and night factors. Size factor during the day is the black line. Size factor during the night is the red line. They behave completely differently. Same thing with value factor. This is also great because they need to behave sufficiently differently for me to have identification looking at their difference. And if you just visually look at the graph, you also realize that fit is primarily correlated with the day component and not the night component. This is the final evidence. I'm redoing the regression I did earlier, explaining returns using flows, with the difference that I now separately do day and night components. These are the impulse responses. The impulse response on the day component returns is very similar to what we saw earlier on the entire component returns. And the component on night returns is very small. I guess there is a little bit of price pressure, it seems, but primarily not. And the impact's primarily during the day. As I argued earlier, I would argue this is difficult to reconcile with alternative hypotheses that don't involve price pressures. I've yet to come across an alternative hypothesis that use a rational explanation and generate these differential predictions. But we have a great audience here. Maybe you can help me think about that.
Jay, we have a question from Sugata. He says, is there some way to use heterogeneous liquidity of stocks in this analysis? Also, I'd imagine this study is much more compelling for the long leg of the anomalies rather than the short legs. Have you tried looking at those separately?
I have not tried to look at them separately. The long and short leg intuition, I'm not sure. That the reason why I didn't go into it is because the analysis here in this paper does not rely on shorting. is just selling. Right? So if you look at value factor, it is long value and short growth. What happens, yeah, mutual funds don't short, but mutual funds can move out of growth. That doesn't involve shorting, it's just selling. So the asymmetry wasn't immediately obvious to me, so I didn't do that exercise. Differential liquidity could be a good action, could be nice to do. Like I haven't done it. Yeah, I just haven't done it. That's a good suggestion.
Thank you.
This is it. This is a very simple paper. To summarize, I show evidence that over 40% of factor movements are non-fundamental price pressures driven by mutual fund style level large reallocations. And the key evidence for the price pressure mechanism is that they happen during the day and not overnight. I appreciate this opportunity to talk to you. I hope to talk to you more. Thank you for your questions.
Thank you, Jay. If anybody has any other questions for Jay and just wants to ask them directly, we'll go ahead and keep this open for a while and just have that interaction. Thank you for everybody for coming. Great turnout for this first seminar. Thank you for Jay for leading off. And I'll just go ahead and stop the recording and allow for that interaction to take place.